Hi, friends. Jim Freeman again from Silverbridge Senior Transitions. And, lately I've been working with a lot of senior clients who are, facing some sort of a transition. Unfortunately, a lot of people wait until it's kind of a crisis to talk about serious issues, or they don't think about some things that they should before entering into the transformation decision process. And one thing that's come up here recently is that I've learned about is a how income from capital gains from the sale of real property, or in some cases the sale of securities, uh, can affect the cost and availability of benefits from Medicare or Medicaid. There may be some private insurance companies that this might affect too. But I wanted to bring on one of my favorite experts, Alexandra Houle, to discuss a specific problem with the cost of what's called in income-related monthly adjustment amounts, or IRMAA. And she's going to give us a short slide after she talks for a minute that'll kind of focus in on this topic. But the problem here is that if you don't plan when you sell your real property to pay for your care, or to not have to take care of a house anymore, or if you have income producing properties, that can result in capital gains. It happens quite frequently in this era where we've had long periods of capital appreciation, in some cases inflation, and the caps on capital gains treatment for your personal residence, your primary residence, which are $250,000 for a single individual and $500,000 for a married couple. You may exceed those caps and find yourself in a position where you've sold a home, or you want to sell a home for as much as you can, and whoops, we have a capital gain. Whoops, that affected the cost of my Medicare coverage. So we're going to talk to Alexandra about that and get some detailed information about how that all works. So welcome, Alexandra. Glad to have you back. We've had you once on before, and you have something to share with us in the form of a slide, I think, tonight.
Yes, that's right, Jim. And thanks so much for having me. I really appreciate it, and it's good to be back. I do have a couple of slides just to make it easier to show how your cost of Medicare might rise due to something like a sale of a house, or other income-related additions. So I will share my screen. That should come up in just a second. All right. Can we see that okay?
I see it fine now. Yeah.
Great. So the reason for this slide is I wanted to start at the beginning. Well, when we talk about Medicare and the cost of Medicare, there is a couple of things to consider. First, Medicare is divided into two parts, and that's your Medicare Part A and Medicare Part B. Medicare Part A, the premiums for that are actually based on your work. So Part A is free to all individuals who have worked for at least 10 years or 40 credit hours. If someone hasn't worked for that long, or doesn't have a spouse that has worked for that long, your premium Part A actually rises quite a bit, up to a little over $500 per month. But our topic of conversation today is actually on Part B, your medical coverage, which is based on income. And most people will tell you, oh, this year I'm paying this amount in Medicare. And that's because there is a start amount that everyone pays. But if your income is higher than that amount, you might find yourself paying more than your friends or relatives are paying.
Higher than what amount, Alexandra?
So this year in 2023, it's $164.90. That's the base premium for your Part B. And then it will go up from that based on income. So the reason why IRMAA, or income related monthly adjustment amount, tends to sneak up on people is because they're not looking at your income this year to figure out what you're actually paying for your Part B. Social Security is the one that looks at your income and figures out how much you're paying for your Part B. and they are always looking at taxes 2 years in the past. So for example, today we're in 2023. So Social Security, once you apply for Medicare, they will look back at 2021. And then every year they readjust that, that amount based on the previous year's taxes. So in 2023, they're looking at 2021. In 2024, they will automatically look back at 2022 and readjust based on that amount.
So I have a quick question on that. So,
Sure.
so it happens every year, not just the year you apply.
That's right.
And what if, like me, that, some people are self-employed and maybe they file their taxes later in the year as opposed to April 15th. How does Social Security do that? How do they?
So that's why they're looking at 2 years in the past, that
Okay.
they give people a couple of years to get all of their taxes done. For individuals that haven't filed taxes in more than 2 years for whatever reason, they estimate based on the closest set of taxes to that 2-year mark. And then if taxes are filed, some individuals might get a letter that says, hey, now that you've filed your taxes, we have readjusted, you have not paid us enough in your Part B premiums. This is what you owe us.
Okay.
Right. So so that's how Social Security deals with taxes being filed later than the usual time frame.
Okay.
So the line that IRMAA is based on your taxes is the adjusted gross income line. So they're not looking at your income that's coming through, they're looking at the adjusted gross income. So just like you, Jim, I'm not a tax preparer, I'm not an accountant, so I cannot give advice. So I always tell my people when they are thinking back on their adjusted gross income, if they're not sure what it's going to be, what it was before, to talk to their accountant or tax preparer and find out what it might have been in the past and what it might be like in the future. And financial advisors also come into play to keep the adjusted gross income amounts under the specific lines that are needed in order to keep your Medicare Part B premiums low. So you can see on the form here on the side that the only individuals that get this base $164.90 are those that either as an individual earn under $97,000 in a year, or those that are filing jointly and earn under $194,000 in a year.
And again, that's adjusted gross income.
That is adjusted gross income, and that's always what they look at, is that line. However, if someone's income was larger than that, you can see that there are brackets for how large is your income, and based on that, how much premium are you going to pay every single month for your medical coverage on Medicare. So you can see at the highest amount, if you have earned over $500,000 as a single individual, or over $750,000, your Part B premium is actually going to be $560.50 per month. And that's quite a difference from the $164.90. In addition to that, you can see the second graph here. Once you get on prescription coverage, which is not included in original Medicare, you will also get an add-on to the cost of the prescription plan. So if that prescription plan is $10 and your single individual earned income is over $500,000, you're actually going to pay $10 plus $76.40 per month for that prescription plan. So it hits twice. Now, if someone decides not to go on prescription coverage, they will not have this amount assessed, but I would not recommend going without prescription coverage, and for multiple reasons that I go over with people at our consultations. So the reason it's important to know what you have had in the past is so that you don't run into a situation where you're paying more than what we thought. And the biggest reason for that is we have people that are working past their age 65, past their Medicare age. And sometimes we'll compare what is Medicare going to cost versus what is their medical insurance going to cost. And if I have someone coming in, they're saying, hey, I'm paying $200 for my employer medical insurance. And I ask them, okay, what was on your 2021 taxes? And they tell me under 194,000 for the two of us. I say, great, Medicare will be lower cost. But then if those same people call me later and say, hey, we did not realize that we had something big happen in that year, and now it's going to be $230, $300, $400, $500. Well, now we've just made the wrong comparison, right? And worse than that, if someone's already in Medicare and they have a bump in one of their years, that bump is going to come calling for them 2 years later, right? Because that's when Social Security is going to readjust that amount. So, so that's a lot of things that you want to watch out for. And the biggest thing, and I think that's why we're here today, is that catches people unawares is the sale of their home. As you mentioned, Jim, there is only so much of your house that you can sell without it then coming to play in your adjusted gross income line, right? Those capital gains. So right now, properties are selling in Washington for quite a lot. I have seen. So if someone sold their house for, let's say, $800,000 and they're a single individual, right? And it's $250,000 or $200,000 that you can write off.
250 is the cap
250 is the cap
for a single individual.
For a single individual. So the rest of that 500, 250, 400, 500, $450,000 is now on their adjusted gross income line, right?
Well, not exactly.
Mhm.
So in your example, you used $800,000. Let's state for the moment that that's the net realizable sales price. That's what they get after closing costs and whatever. And let's say they bought the home 30 years ago for $100,000. So they would add their original purchase basis, 100,000, plus the cap of 250, and deduct that 350 from the 800 to determine their potential capital gains liability.
There we go. So that is something to consider. And if you add that to the income that you already have coming in through your job or Social Security benefits or a pension, now you're far more in your adjusted gross income that you would have been without the sale of that home.
For that 1 year.
For that one specific year.
Right.
And that year, 2 years down the line is when you're going to see that adjustment come back to you. So in our case, let's say that that house bumped you even only under $500,000, right? And if you look at the line for a single individual between $183,000 to $500,000, you can see that that person just went from paying $164.90 for that Part B premium all the way up to $527.50.
Yeah, so it can make a difference.
It can make quite a significant difference for people, especially ones that have no idea this is going to happen to them. Right. Most people forget about the sale of the house 2 years down the line when we're calculating things, is what I found in my experience. Right. So now I've actually made it part of my presentation, sometimes a joke. Hey, you haven't done anything big like won the lottery or sold your house, right? 2 years ago, to make sure that you know, we're not facing this kind of IRMAA experience. And I have worked it out with individuals who, let's say they are working quite a bit right now, and they have been working and they've made quite a lucrative income for themselves in the past couple of years, but they're planning to retire. Or they have already partially retired and their income for the last year has been significantly slim. We have planned it to the point where we'll wait for those 2 years to pass before we start Medicare to avoid a lot of these IRMAA increases. So I have a gentleman right now that we actually decided that we're going to wait until 2024 because he had one very, very good year in 2021. And that would have that would have almost doubled his Part B premium this year.
Mhm.
And his then added to his Part D as well. So we've actually made it so that he transitions in 2024 when his 2022 taxes are the ones that are being spotlighted, in order to make sure that he doesn't get hit with that IRMAA.
Well, so that's new information for me. So I understood that when people turn 65, that they're required to enter into Medicare. Otherwise, they have to pay a penalty of some kind.
No, not specifically. So if someone continues to work past their age 65 for an employer who provides them with medical coverage,
Mhm.
in most, but not all, there are a couple of rules to watch out for, but in most cases, that individual has the right to either keep on their employer coverage or transition to Medicare anytime after their age 65.
Okay.
Things to watch out for is if a person is self-employed, we can't do that. If an employer is under 20 people, we can't do that. If someone doesn't get prescription coverage from their work, they don't have a choice. If someone has a very, very high deductible plan or COBRA, also not considered creditable by Medicare, so we can't rely on that. But we have more and more people that are continuing to work. And so for those individuals, we can strategize in this way.
All right. So the takeaway really is for certain individuals, it pays handsomely to talk to somebody like you to try to forecast in advance what the effect of various decisions about continuing to work or what's going to happen to their income might be and how it's going to affect their cost of medical care.
That's right. That's right. If someone is not yet on Medicare, but they're going to be transitioning, I always recommend, whether you're going to continue to be employed or not, to consider consultation so that we can make sure we avoid these kinds of pitfalls, or have a conversation about how we might mitigate some of these big changes based on income. So, we talked about a sale of a house, which is generally a one-time event. But what if someone is just bringing home a very large salary, right?
Mhm.
And once they retire, obviously that salary is no longer going to be serving them. They can't afford, in some cases, to wait for 2 years, right? Wait and sit out those large premium payments. So in certain cases, we can use what's called a IRMAA reconsideration form for a life-changing event. And this is a very specific form that you can only use once in your entire lifetime. So you can't use it more than once. So it's a pretty strategic form there. And you can only use it when you have a qualifying event. And you can see there in the bottom, it's your usuals, which is marriage, divorce, and death of the spouse, right? That can make a great changes to your income. There is the work stoppage or work reduction. There is the loss of pension income. And there's 2 other ones that I want to make sure we go over so that people know how to use them. The employer settlement payment can't just be used for someone who gets their final payment for leaving. It's got to be because that employer is either being sold or going out of business, and that's why they're giving their employees a big settlement. So it's not for any old, I'm leaving, so give me all of my vacation pay kind of situation. And then the loss of income producing property I found is one that is very difficult to use because it's not anything having to do with a voluntary sale or transfer of a property. So if you have a property that produces you income, let's say a rental, and you sell it or transfer it to someone else, that's not going to be a life-changing event. This particular line is only for situations where that loss was not voluntary, meaning there was a flood or a fire and you lost your property that way. There was a theft or arson or a fraud, where that home got forcibly taken away from you. That is the only time where you are able to use that particular life-changing event. But it is there. So
Okay.
I do talk to people about making sure they fill out that form when they retire, or matching the start of their Medicare to their retirement, even if their spouse, for example, is still working and they might be on their medical plan. So there's a lot of little rules to using this form, but there's definitely ways where we can minimize or avoid those IRMAA increases to Part B if we get ahead of it, right, rather than behind it.
Well, that's really the topic of our call here tonight. So you've just explained, I think, well, how, and I'll guarantee you 99.99% of people are not going to know anything about this.
Yeah.
So the free consultation with you could turn into a very valuable tool that might save them hundreds of dollars a month in increased premiums for the same care they might get otherwise. So it makes sense to talk to you. But what you just said about pre-planning. So I'm, as a senior transition specialist, somebody that helps seniors with the overall picture of trying to determine, do they need to move? If they do, where are they going to go? What are their circumstances? What resources do they have to pay for this care? What's it going to cost? Where are they going to be happy? What's going to happen, with their families? How are they going to support it? Those are kind of the counseling steps. But the way that I get paid, I'm a real estate broker. So I may, if there's real estate involved, and there isn't always, sometimes we just provide free counseling. The question that I get asked most often is, how can I get the most for my property, my home, usually? How fast is it going to take? And because I need this money to pay for my care, which is oftentimes very expensive. It's certainly more expensive than what they're used to paying for living in their homes and taking care of themselves when they're able to. But things change when you can't anymore. And if other people have to step in, generally they're going to be paid. And how do you pay for it? Well, for the most of us, the sale of the home is a big item. And so it's not the right question is not how much is it worth and how fast can I get it. The right question is how much can I really put in my pocket with option A, option B, option C, and what happens if I'm lucky, fortunate enough to sell my property and I incur a capital gain? What are the consequences of that? Well, there are consequences certainly for payment to the government. You may have to pay some capital gains tax. Like you say, I'm not a CPA, so we would involve a tax planning expert of some kind in that decision-making process. And are there ways to defer those capital gains? And oftentimes there are. And more importantly, getting a lump sum of money is great, I guess. And you may need to do that in order to pay for your care, your very expensive care. However, are there things that can be done to both defer capital gains and to produce income using the liquidated amount of that asset? And there are some strategies that way. There are ways to do that, which would involve a tax planner and, again, other people besides just you and me. But you're the part of the puzzle that tells us about how's it going to affect our access to Medicare benefits, and what's it going to cost me? Is there anything I can do to plan for that? And I think you've just laid out 2 or 3 things you could do. Another thing which you and I are not experts in, but is Medicaid. And if a person is trying to plan for Medicaid, which is a much more complicated process and takes longer, but that could be part of your overall strategy for converting your highly appreciated assets, like a home, into some kind of income producing and getting the kind of care that you're probably going to need. All right, so why don't you go to the next slide so we can see how to contact you.
I will go backwards to the very beginning here. It's at the bottom.
All right.
I do want to mention about Medicaid. It's definitely, if you're considering or someone is considering the need to go into a a place other than your home for the remainder of the life. And Medicaid is a big part of how you're going to pay for that. I would always recommend a Medicaid attorney if you're going for long-term care Medicaid, which is specifically there to provide for the costs of long-term care, which Medicare does not cover. So the only time Medicare covers stays in the facility is if a person is recovering. That is, they've been in a hospital with some kind of event, and now they've been pulled in a skilled nursing facility in order to get better before they can go home. That Medicare does have coverage for. But if it is somewhere where it's known as custodial care, that's someone who needs help for the rest of their life, Medicare doesn't cover, but Medicaid can come in. The problem with long-term care Medicaid versus the regular Medicaid, which is available to individuals that don't need help with the costs of their long-term stays, is that there are a lot of rules, and there is a huge look back period that is included in those rules. So, you know, you have me for the Medicare, but if someone is looking at how am I going to finance those long-term care facilities, definitely need to get to know a little bit more about what might stop you from being able to get Medicaid. And things like, oh, I'm just going to give all my savings away to my kid or my neighbor or, you know, to someone else. Actually, it's not that easy.
No,
And
it's
that
not.
might be so, and that's just what I wanted to mention, is that Medicaid is complicated, and other than the CPA or the tax preparer and the financial advisor, and you, Jim, with your knowledge of real estate and property, and myself and Medicare, I'd also recommend a Medicaid attorney to talk to make sure that people don't fall into any pitfalls that might stop them from getting that Medicaid when they actually need it, rather than years down the line where it's no longer time for it.
Right. So I kind of call that the love team. Now,
Yes.
you know, hopefully not everybody does, but hopefully when a senior is approaching a transition decision, they have family, they may have some, you know, an attorney or an accountant or some other advisors that have helped them up to this point. And, you know, those advisors may be perfectly suited for what comes next. But in my experience, they don't, you know, the competency from one sort of consultation and advice doesn't necessarily carry over to the types of issues we're discussing. So, but, you know, we want to work with everybody. We want to work with the senior. We want to keep them in charge of their decision-making process as much as possible. And so, you know, the love team could include all those people, but it should include certain experts with competency in the issues that specifically are oriented to seniors, like we discussed tonight. Okay, well, enough of the soapbox. So if somebody wants to get a hold of you, I see your information is down on the bottom here. We'll also put that in the comment section or the narrative section below, where we're going to post this on our blog and other places. But you can get Alexandra. Her phone number is 206-591-4262. Alexandra at MyMedicareSolution.com. Alexandra, thank you so much. It's always a pleasure to have your help. And I just say also that, you know, I have referred you to numerous seniors who you have helped greatly, really made a change in their life by either reducing their premium costs or improving their care coverage to solve specific medical issues that they were having. So, oh, and by the way, you're my Medicare expert. So there's an endorsement there. So great. We'll stop this recording now, and you know, the next time we have an issue to talk about, that's what we'll do.
Thank you, Jen.